Chapter 2 IT BPM Engagements. So before we proceed to our main topic, let us first define what is KPI and SLA. Key Performance Indicator is a set of quantifiable measures that a company or industry uses to gauge or compare performance in terms of meeting their strategic and operational goals. KPIs vary between companies and industries depending on their priorities or performance criteria, also referred to as key success indicators. Service Level Agreement or SLA is a part of service contract where a service is formally defined. In practice, the term SLA is sometimes used to refer to the contracted delivery time of the service or performance. IT BPO 3 Fundamentals of Business Process Outsourcing 101. So let us get started with our first topic, client service provider relationships. Part of this first topic are key concepts like attributes, scope of work or SOW, master services agreement or MSA, and core elements. So under the attributes of client service provider relationship, client company is concerned with quality transition of process, efficient operation of business functions that were once handled in-house, while the service provider company is concerned with scope of service, performance measures, benchmarks to ensure objective standards in assessing work quality. The nature of outsourcing is when a client company fully entrusts or turns over the successful delivery of a service formerly handed in-house to either a third-party or shared service center service provider or vendor company. Let's proceed to the IT BPM contract. An IT BPM contract is created for the benefit of both client or buyer and the vendor or service provider. Therefore, as a result of these relationship attributes, the IT BPM contract is unique, tailor-fit agreement captured in a document that resembles a performance contract. A business process management or IT BPM contract is a formal agreement between a client and a service provider to take over a pre-agreed portion of the client's business operations. This pre-agreed portion is documented in the contract as the scope of work or SOW. The IT BPM contract with all its attachments, assumptions, and documented agreements is referred to as the Master Service Agreement or MSA. So under the scope of work, it describes specific work to be delivered by when, at what cost. So here there is some considerations like can be similar to a job order, is generally an attachment or addendum to a master service agreement, points to covering terms. May state that in case of terms inconsistency, the SOW or master service agreement supersedes. It is a formal document that captures and defines the work activities, deliverables, and timeline a vendor must execute in performance of specified work for a client. In Master Services Agreement or MSA, covering the agreement that summarizes terms applicable to every job order with the service provider. So here's the main element including service to be provided, performance management, issues, change management, and country loss. It is a contract that contains generic terms regarding requirements and obligations of the contracting parties, which in this topic are the client and the service provider. There is also a different core elements. First, service to be rendered or provided as documented in the scope of work, which includes the outbound sales calls, inbound inquiries or subscriptions, and delivering food or flowers or mail. Service to be rendered or provided as documented in the scope of work, it covers exactly what the client is turning over to the service provider. Second, performance standards expected from the service provider. Service Level Agreement or SLA and Key Performance Indicators or KPI, including handle time and average handle time, sales attainment, and customer satisfaction rating. So, performance standards expected from the service provider, we are inferring to criteria that is critical to the client that service provider is able to consistently attain. A service provider that takes calls for another company regarding directory assistance sets the performance standards at an average of 60 seconds to complete one call. If the agent hits the average, he or she delivers what is expected from him. If he or she fails and takes more time to finish a call, that makes him or her inefficient and would incur the company some added cost. So third, timeline of the contract. Start date, go live, and duration. It is a detailed schedule of when the transition period starts and when the service provider assumes control of the contracted processes. In terms of the type per duration, most contracts are typically multi-year contracts. However, and when deemed most effective, on-demand contracts may also be put into effect. When we talk about timeline of the contract, it refers to two things. When will the transition start and for how long the contract will be in effect? So fourth, cost to the client refers to the payment made by the client to the service provider for honoring contractual agreements. And lastly, other specific operational requirements. Who will provide the service? Qualifications of personnel, locations of operations, outline of reporting procedures, decision-making, and escalation of problems, legal provisions, non-competition confidentiality. When it comes to the other specific operational requirements, we are referring to very specific contractual details that protect both to the client and service from ambiguity. Taken together, these core elements empower the relationship between the client and the service provider.
Let us get started with our next topic, the IT BPM contract pricing models. There are two pricing models. We have the fixed pricing model and time and material pricing model. The first one, fixed price, easy to plan and more predictable than other pricing models. A fixed pre-agreed price unit is negotiable. Example, a fixed price per transaction. So when we say fixed price, it allows you to leave all the work to the developers until the product is ready because in fixed price, the price is already arranged. So example dito is sa rental, sa mga rental ng mga boarding house. Kumbaga, magkakaroon ng agreement sa may-ari at sa titira dito na 1.5 kada buwan ang babayaran mo sa boarding house at dun na pumapasok yung fixed price na tinatawag dahil mayroon na presyo or nakapirming babayaran. Example din dito is sa construction, nagkakaroon din ng or pwedeng magkaroon din ng agreement or kontrata for 1 year at sa 1 year na yon ay ipagpalagay na lang natin na may naka-fix ng sahod ng mga manggagawa at yun ay nagkakahalaga ng 500,000. So, matapos man o hindi yung gagawin sa construction site, mababayaran pa rin sila ng yun yung nasa kontrata at napagkasunduan na. We have also the advantages for service providers. It is known in advance what will paid and what will be delivered. So gaya nga ng sinabi ko kanina, alam mo na agad bilang isang client kung ilan o magkano yung services na gagawin sa'yo. So alam mo na kung ilan yung babayaran mo. Advantages for clients provides greater cost certainty. Kung may advantages for services, mayroon din naman advantages for clients. Yun naman ay it provides greater cost certainty or yung tinatawag ng pagkakaroon ng seguridad at katiyakan ng mga mababayaran or seguridad na mababayaran agad siya sa services na ipapagawa sa kanya. Next, we have the disadvantages for clients. Several risks with capital requirements and lower flexibility. So may disadvantage din ang fixed price Of course, kung alam na ng mga construction worker na mababayaran sila matapos man o hindi yung kontrata nila, there is the possibility na hindi na nila gawin on time or maayos yung trabaho nila. Number 2, time and material price model. The price for service is based on the time and material is needed. So kung sa fixed price is you already know the price, dito naman sa time and material price model is nakabase yung price for services kung ilan yung oras na nagawa o natrabaho plus the actual cost of material use at yun yung babayaran mo. So dito maiiwasan yung overpaying na tinatawag. Next, use when a service very flexible and if it is not predictable in terms of how much time and material is needed. In some cases, a maximum price for the service is negotiable by the client or customer to build in some control of safety level. Gaya ng nabanggit ko kanina, maiiwasan yung overpaying na tinatawag. So dito sa time and material price model, the client or the customer build in some control or safety level.
So our next topic is all about the IT/BPM contract financials. So here we're talking about the CAPEX and OPEX. So when we say CAPEX, it refers to capital expenditure, and OPEX, it refers to operational expenditure. So what is CAPEX, or the capital expenditure? So it is a business expense incurred to create future benefit. So expenditure or assets like a building or the physical space, machinery, equipment, or upgrading existing facilities so their value as an asset increase. So CAPEX or capital expenditure, these are the funds where the company use it to acquire, upgrade, and maintain physical assets. So CAPEX is usually used in making new projects or investment by a company. So we have another definition of CAPEX. Repairing a roof, acquiring a piece of equipment, or establishing a new factory are all examples of capital expenditures on fixed assets. Companies make this form of financial investment to expand the scope of their business or to gain a competitive advantage. Another, any amount spent by a firm on fixed tangible assets is known as capital expenditure or CAPEX. It is also known as capital outlay. Any assets that will be used in the future beyond the present accounting period are classified as fixed assets. Assets such as real estate, land, electronics, vehicles, equipments, and machinery are those examples. When it's time to refresh an old project or start a new one, most businesses will turn to CAPEX in the hopes of making a profit. So next is OPEX. So what is OPEX, or the operational expenditure? So it is the money the business spends in order to turn inventory into output or throughput. These are operating expenses, which also include depreciation on plants and machinery which are used in the production process. So OPEX, or operational expenditure, it refers to the cost that your company incurs while it produces goods and services. So another definition of OPEX. OPEX are the finances that helps you run your daily basis. Example, include consumables such as printer cartridges, paper, electricity, and other supplies. So let us move on to comparison of CAPEX and OPEX. So the definition under CAPEX: capital expenditure are expenditures creating future benefits. A capital expenditure is incurred when a business spends money either to buy fixed assets or to add to the value of an existing asset with a useful life that extend beyond the tax year. So, the definition under OPEX: it refers to the expenses incurred in the course of ordinary business, such as sales, general and administrative expenses, and excluding cost of goods sold or COGS, taxes, depreciation, and interest. So CAPEX, also known as capital expenditure, capital expense. OPEX, also known as operating expense, operating expenditure, revenue expenditure. So under accounting treatment, CAPEX cannot be fully deducted in the period when they were incurred. Tangible assets are depreciated and intangible assets are amortized over time. Under OPEX, operating expenses are fully deducted in the accounting period during which they were incurred. So, in CAPEX, it cannot be fully deducted in the year in which they occur. Intangible assets are amortized over time, whereas tangible assets are depreciated. Under OPEX, operating expenses are deducted in full within the accounting period in which they occurred. So, let us move on in output or throughput accounting. Under CAPEX, money spent on inventory falls under CAPEX. Under OPEX, the money spent turning inventory into output or throughput is OPEX. So, CAPEX in operations, costs incurred for acquiring fixed assets, property, or equipment. Under OPEX, costs associated with the operation and maintenance of fixed assets. So, examples: under CAPEX, buying computer hardware, acquiring intellectual property assets like patents. Under OPEX, salaries and benefits, maintenance and repair of computer hardware, utilities, rent, business development, and employee engage expenses. So that's the comparison of CAPEX and OPEX. In the next segment of this statement, we have the line that reads, tangible assets are depreciated. So let us first define some terms. So first, tangible. So tangible, something that is capable of being perceived with the sense of touch. So there are examples of tangible. Example is inventory, cash, vehicles, equipment. So those are examples that can be sensed. So next is the assets. Assets, items with economic value owned by an individual or a corporation which could be converted to cash. So the examples are inventory, investments, vehicles. So next, depreciated, lessened or diminished the value. So moving on to intangible assets, are amortized over time. Intangible assets are not physical in nature, such as intellectual property, patents, trademarks, copyrights, and business methodology, all of which are worth billions of US dollars or euro. In recent technology news, Samsung lost to Apple in court. The loss was because of patent copyright infringement. So, an infringement is the intentional or unintentional profiting from an idea, design, concept that is legally owned by another individual or corporation without the owner's knowledge and consent. Similarly, RIM BlackBerry is paying Nokia no less than 50 million euro. So, next word is amortized. In accounting terminology, amortization refers to expensing the acquisition cost minus the residual value in a systematic manner over their estimated value as a result of use of time. For example, training bonds. Your company sent you to a highly specialized certification course for Six Sigma at the expense of the company. You will be required to sign a bond that requires you to render additional X years of service using the knowledge and skills that you acquired in the course for the benefit of the company. If you option to leave the company prior to the expiration of X years, you will be required to pay for a sizable portion of the cost paid by the company for your certification. So, that's all for CAPEX and OPEX.
Components of process costs. Process costs associated with roles, activities, processes, tasks that may be outsourced by the offshoring outsourcing strategy. They are as follows. 1. Labor costs, compensation, benefits, bonuses, incentives. When we say compensation, it is like salary and wages refers to the money paid by an employer for services rendered by its employee. Next, we have benefits. Benefits have two types: the ones required by law that the employer provide to its employees and ones provided by the company or the employer. Bonuses are given based on what an employee has done, while incentives are given to motivate an employee towards the goals. Two is direct costs. They are as follows: employee development or training, employee relations programs, employee tools, equipment, for example, desktop computers, communications, coordination and management, travel, representation, meetings, and workshop. 3. Indirect costs. Infrastructure. Indirect costs for network, mail, and other shared employee services, rental, depreciation, amortization. Other charges: head office or regional shared cost allocation, interest costs, foreign exchange gains and losses. For us to explain infrastructure costs, let us look at our malls with multiple vendors. Each vendor pays a fixed rental price along with other mall amenities like electricity and water. So, if the mall were to offer free Wi-Fi to shoppers and guests, it is really free. Now, when it comes to other charges, let's look at Coca-Cola as an example. You would have to travel very far to find a Coke-less area of the Philippines. This nationwide availability is made possible through a well-thought distribution system, a system heavily dependent on the efficiency of multiple stakeholders, with each representing a handoff before the final customer or consumer. The shared costs here are the components of that distribution system: long-haul freight, trucks, delivery vans, and delivery tricycles.
Our next topic is the component of loaded onshore costs. These are the following loaded annual costs. We have compensation, benefits, and infrastructure. Ang compensation is the salary and bonuses. Ito yung sweldo at ito yung dagdag ng sweldo na kadalasan na nakukuha natin sa tuwing holidays. Katulad ng December, Christmas Day, mga ganon. At marami pang iba. Ang susunod ay benefits. We have the training, health, and life insurance. Profit sharing, pension matching, workers' compensation, employer share of payroll, and social security taxes. These are the benefits given to employees. And the last is infrastructure. We need to consider the facilities, venue rent, and IT support. These are the loaded annual costs. The next is regulatory requirements. We have two major types of regulatory requirements. Number one is adherence to government regulations. External. We have Board of Investment, Bureau of Internal Revenue, Bureau of Immigration, Department of Labor and Employment, Pag-ibig Fund, Philippine Economic Zone Authority, Security and Exchange Commission, Social Security Service, Data Privacy Law. These are the external regulations. External regulations refers to the various government regulations from the appropriate government agency. Second, industry company regulation, internal. We have institutional and operational standards, policies, guidelines. Services provider implement on regulations. Ito yung sa loob ng company, this is the company regulations na ipinapatupad katulad ng mga policies, guidelines sa loob ng company. They also implement their own regulations. The internal regulations refers to the regulations levied by the industry upon itself to ensure the standardization of various practice for its own benefits. Let us discuss some of the internal requirements. We have the Board of Investment, or BOI. A Republic of the Philippines agency created under the Department of Trade and Industry. It strives to attract direct investment into the country to contribute to economic growth and jobs creation in the Philippines. Let's read the BOI qualification. A Philippine enterprise can register their project with the BOI if the proposed activities is listed as a preferred project in the current IPP or Investment Priorities Plan. The said internship may engage in domain-oriented activities in the IPP, whether classified as pioneer or non-pioneer.
Business Process Outsourcing, or BPO, is the delegation of one or more IT-intensive business processes to an external provides that, in turn, owns, administrates, and manages the selected process based on defined and measurable performance metrics. BPO requirements. There are 5 BPO requirements. There are DTI registration, SEC registration, audited financial statement and income tax return for the past 3 years. Board resolution to authorize company representative. Accomplish application form 501 and project report. DTI registration or Department of Trades and Industry registration, the requirements is only for sole proprietorship or a single. And in SEC registration is corporation, branch office, regional headquarters. Philippine Economic Zone Authority or PESA is attached to the Department of Trades and Industry, the Department of Special Economic Zones throughout the country, and the very competitive incentives available to investments inside PESA. Special economic zones are embodied into a Special Economic Zone Act of 1995, which was Republic Act number 7916, a law that passed by the Philippine Congress. Philippine promotes investments, extend assistance, register, grant incentives to and facilitate the business operations of investors in export-oriented manufacturing and service facilities inside selected areas throughout the country proclaimed by the President of the Philippines as PESA, Special Economic Zones. There are qualifications in PESA. It is export-oriented enterprise that are found in any of PESA Special Economic Zone. These are the requirements of PESA. 1. Duly accomplished and notarized PESA application, form, and anti-graft certificate. 2. Corporate profile, including that of parent company. 3. Board resolution authorizing the filing and designation of a representative. 4. Securities and Exchange Commission or SEC Certificate of Registration, Articles of Incorporation and Bylaws. If not available, submit draft or Articles of Incorporation. Last, project brief. Example, information on market, technical, financial, and management aspects of the project to be registered. And data privacy law or the Republic Act number 10173, an act protecting individual personnel information in information and communication system in the government and the private sector, creating for this purpose a National Privacy Commission and for other purpose.
Industry internal regulatory requirements. Industry-specific regulations. Control of communication channels and information systems, Article 16. Under the industry-specific regulations, the communication channels and information systems of the bank shall be controlled to ensure that information obtained within the bank is reliable, complete, traceable, consistent, in a suitable format and character to meet the requirement and accessible by relevant units and personnel in a timely manner. Second is industry-specific regulations, auditing of partnerships subjects to consolidation. Article 34. Under this, banks shall take all necessary measures to ensure that their internal audit units can inspect all activities and units of their consolidated partnership without limitation. With these two examples, it is evident that it is in the best interest of an industry and its members to implement and enforce such measures. The cumulative effect benefits both member companies despite the fact may be competitors in their respective clientele.
That's all for today. Thank you for listening.